All right, so you're building a startup, and sooner or later, you're probably going to need to raise some money. But what are you actually selling to investors when you do that? Is it stock, a loan, something in between? Well, we're going to demystify all of those options right now.
So, you've got it, that brilliant idea, the one you know could be a total game changer. It's an amazing, exciting feeling, right? But then comes the hard part. Turning that incredible idea into a real, functioning business usually means you need to raise money. And honestly, it can feel overwhelming. So let's make it a little easier by focusing on one of the very first and most critical decisions you have to make. What are you actually going to offer those investors?
Yeah, raising capital is that first huge hurdle. And a massive piece of that puzzle is deciding what kind of security you're going to issue. Believe me, this choice sets the stage for your entire relationship with your investors down the road.
Now, you should think of this explainer as your cheat sheet. Our goal here isn't to give you legal advice. You absolutely need to talk to your own lawyers for that. But we can arm you with the knowledge to have a much smarter conversation with them, so you can pick the security that's genuinely right for you and your company.
Okay, so where do we even begin? Let's start with the absolute basics, equity. This is the classic, most traditional way to invest. You are literally selling a piece of ownership in your company.
First up, we've got common stock. This is the plain vanilla, most basic form of ownership. It's what you and your co-founders probably have. But here's the crucial thing to understand. Professional investors almost never take common stock. Why? Because they want something with a lot more power.
And that something is preferred stock. The name really says it all, right? It's preferred because it comes with a bunch of special rights. And the most important one is this. If the company gets sold, preferred stockholders get their money back before the common stockholders see a single penny.
This example makes it crystal clear. A company raises $1 million, but later it sells for just $900,000. So what happens? The preferred investors get all $900,000. The founders, holding common stock, they get nothing. Zero. That right there is the raw power of what's called a liquidation preference.
And that liquidation preference is just the appetizer. Preferred stock is really like a whole menu of rights that investors can pick and choose from during a negotiation. We're talking about things like getting a board seat or the right to invest more money in future rounds. It is super customizable.
Okay, but what if you're so early that you have no idea what your company is worth? I mean, agreeing on a valuation at that stage can be almost impossible. And that is exactly why these hybrid securities were invented. They're designed to kick that valuation can down the road.
By far, the most popular hybrid you'll hear about today is the SAFE. It stands for Simple Agreement for Future Equity. The idea is, well, simple. An investor gives you cash now, and in exchange, you promise to give them stock in the future, once you do a proper funding round where you actually set a price for your company.
Let me just walk you through how it works. Say an investor puts in $100,000 today on a SAFE. 2 years from now, you raise a big $2 million round at a price of $10 per share. That investor's original $100,000 just automatically converts into 10,000 shares at that new price. See? Pretty straightforward. Now, of course, that early investor took on a ton of risk, right? So they need to be rewarded for it. That's why SAFEs almost always include sweeteners, like a discount on that future share price, or something called a valuation cap, which basically sets a maximum price for their conversion. It protects them if your company's value just goes to the moon. Now, before the SAFE took over Silicon Valley, there was its predecessor, the convertible note. It works in a very similar way, but there's a key difference in how it's structured. It's actually a loan that can either be paid back with interest, or, and this is what usually happens, it converts into equity later on. And this is the absolute core difference. A convertible note is actual debt. It has an interest rate. It has a maturity date when it has to be paid back. A SAFE has neither of those things. It's not a loan. Honestly, the easiest way to think about it is that a SAFE is just a convertible note with all the debt features stripped away. Okay, so we've talked about selling equity now, and we've talked about promising equity for the future. But what if you don't want to sell any ownership at all? Well, there are alternative paths that let you raise money by sharing your revenue instead. One of these options is called a revenue sharing note. With this, an investor gets a slice of your top-line revenue, not your profit, your revenue, for a certain amount of time or until they've hit a specific return on their investment. So, as you can see here, the investors are just taking a small slice, in this case, 5% right off the top of every dollar that comes in the door. The beauty of this is its simplicity.
It's focused on the actual cash you're generating, not on profit, which, let's be honest, can be a lot harder to calculate.
And here are the big trade-offs. For you, the founder, the pro is huge. You don't give up any ownership. It's non-dilutive. The con? You're using up precious cash flow to pay back investors. For the investors, they get their money back much faster, but they miss out on that grand slam home run, that 100x return that they could get with an equity stake. And finally, we have the simplest, most old-school option of all, a simple loan. A promissory note. You get cash now, and you promise to pay it back later with interest. It's clean, it's non-dilutive, but you absolutely have to make those payments, no excuses.
Okay, wow, that was a lot. We've covered stock, safes, convertible notes, revenue sharing, simple loans. So with all of that on the table, how in the world do you choose the right one for your company? Well, this is probably the most important takeaway of all. There is no single best security. It just doesn't exist. What's perfect for a pre-revenue tech startup is going to be totally wrong for a business that already has steady cash flow. It is a strategic decision that completely depends on your specific context.
So this is your cheat sheet for thinking it through. Are you really worried about dilution and giving up ownership? Then you're probably looking at a revenue share or a loan. Do you absolutely need to postpone that tricky valuation conversation? A safe is your best bet. And if you're raising from a traditional venture capital firm, well, you can expect to be talking about preferred stock.
So we'll leave you with this final thought. Your choice of security isn't just a boring financial decision buried in legal documents. It tells investors a story. It tells them what kind of company you're trying to build, what you value, and where you plan on taking it. The only question left is, what story do you want to tell?